All right, let's talk about UAE VAT on real estate. I know, I know, it can feel like a really tough topic, especially if you're gearing up for your exams. But trust me, it's not as scary as it looks. Today, we're going to break it all down piece by piece so you'll have everything you need to absolutely nail those questions. Let's dive right in.
So here's what we've got on the agenda. We're going to kick off with some real estate VAT 101, just the basics. Then we'll jump into the big one, residential versus commercial. After that, we'll get into the nitty-gritty of exempt or zero rated, a real exam favorite. We'll touch on bare land and mixed-use buildings, and then we'll wrap things up with the capital assets scheme.
Okay, let's do this. Section 1, Real Estate VAT 101. Think of this as the foundation. We've got to get these fundamental rules down cold before we can build on them with the more complex stuff. So, first things first, what is real estate when we're talking about VAT? This is super important. It's treated as a supply of goods, not services. Why does that matter? Well, it means the place of supply is always where the property actually is. Simple, right? So for everything we talk about today, we're talking about property right here in the UAE.
Okay, so when do you actually have to account for the VAT? The rule is just beautifully simple. It's the earlier of two things, the date you get paid or the date you issue a tax invoice. Whichever one of those comes first, boom, that's your tax point. Easy to remember, but absolutely crucial. All right, moving into section 2. Now, I want you to really lean in for this part because this is the core distinction for the entire topic. We're talking residential versus commercial property. Seriously, if you can get this difference locked in, you're already halfway there. So what exactly is a residential building? It's pretty much what you think. Any place intended for people to live. You know, apartments, houses, student dorms, nursing homes, that kind of thing. But, and this is a big but, look at the exclusions. Hotels and serviced apartments do not count as residential for VAT purposes. That is a classic exam trap, so make a mental note of that one. And commercial buildings? Well, that's easy. It's basically everything else. If it's not residential, it's commercial. Simple as that. We're talking offices, warehouses, shops, and yep, those hotels we just mentioned. They fall right into this category. And here's where it all comes together. Look at the difference in treatment. For residential buildings, the default rule is that they are exempt from that. But for commercial buildings, nope. They get hit with a standard 5% VAT rate. This right here, this is the fundamental split that everything else is based on.
Okay, on to section 3. Now, we just said residential buildings are exempt, right? Well, it's not always that simple. This is where things get really interesting because we're diving into the difference between exempt and zero rated. And let me tell you, this is a topic that examinators absolutely adore. So let's start with the general rule. Just remember this. Most of the time, residential property is exempt from VAT. Simple. But as with everything in tax, the exceptions are where the real points are scored. The trick is knowing when that general rule just doesn't apply. So let's check out the biggest exception. And to understand that exception, let's just imagine a scenario. Picture this. A developer just finished a shiny new apartment building. They're about to sell one of the apartments for the very first time. So what's the VAT on that sale? Based on what we know, you might think it's exempt, right? Well, surprise. The answer is no, it's not exempt. Check this out. The very first sale of a brand new residential building, as long as it's within 3 years of completion, is zero rated. Now, why is this such a big deal? It's all about recovering input VAT. If a supply is zero rated, the developer gets to claim back all the VAT they spent on building materials, labor, everything. If it were exempt, they'd get nothing back. See? That's the huge difference. After that first sale, any sale after that goes back to being exempt. Oh, and don't forget that little gem at the bottom. Short-term rentals, anything under 6 months, they're treated just like a hotel and get the standard 5% rate. All right, let's keep moving. Section 4 is all about a couple of special cases you're definitely going to run into. We're talking about bare land and mixed-use buildings. Bare land is, well, exactly what it sounds like. It's just a plot of land with nothing on it. No buildings, no major construction. And the rule is super straightforward. The supply of bare land is exempt from VAT. That's it. Now, of course, the second you start building on it, that can change everything. Okay, so what if you have a building that's doing two things at once? You know, shops on the bottom floors and apartments up top. That's what we call a mixed-use building. The key here is to think of it like it's two separate buildings in one. You have to split it for VAT. So the commercial part, the shops, that's easy, standard rated at 5%. And the residential part, the apartments, well, you just apply all the residential rules we just went over. They could be 0 rated or exempt, depending on the situation. All right, we're on the home stretch. Our final topic, Section 5, is the capital assets scheme. Now, this one is for the big ticket items. We're talking about really high value property investments. So what do we mean by high value? There is a magic number here you need to burn into your brain, 5 million dirhams. If a business buys an asset, like a building, for 5 million dirhams or more, it's automatically part of this scheme. So how does this thing actually work? It's basically a 3-step process you'll repeat. First, when you buy the asset, you claim back the input VAT based on how you plan to use it for taxable purposes. Simple enough, but then comes step 2, and this is the ongoing part. Every single year, you have to review how you're actually using the asset. And that leads to step 3. If the use changes, say you turn a standard-rated office into an exempt apartment, you have to make an adjustment. That might even mean paying back some of that VAT you claimed at the start. Whew, okay, that was a whirlwind. Let's do a super quick recap of the absolute must-knows. 1. Residential property is usually exempt. 2. But the first sale of a new residential property is 0 rated. That's the big one. 3. Commercial property is simple, always 5% standard rated. 4. Bare land is exempt. And 5. Big assets, over 5 million dirhams, fall under the capital asset scheme. Got it? So I'll leave you with this to think about. Now that you know the rules, which of these do you think actually causes the most headaches for businesses out there in the real world? Is it trying to figure out the VAT on a mixed-use building, or maybe it's that tricky 0 rating rule on the first sale of an apartment? Thinking about the practical side of things is a fantastic way to make sure this all sticks. Thanks for tuning in.